My name is Mike Sullivan. I'm a former IRS agent. I want to talk to you today about the alter ego. It's important you listen to what I have to say because I've been in private practice, but I worked for IRS, so it's like you get the best of both worlds for me. Anyway, let's talk about the alter ego really quick. So as an agent, I would go ahead and I would work a case. People owed thousands, hundreds of thousands, millions of dollars, and I'd be looking at their property and doing my due diligence. All of a sudden, I would see this property, and it all of a sudden disappeared into a trust, disappeared into a partnership, disappeared into another name. Well, at one point they owned the property, all of a sudden they owed the tax, and boom, the property's gone. Well, IRS goes after that property through the alter ego doctrine. Alter ego simply means there's another self. There isn't. The other self usually is a trust, a corporation, an entity. So basically, if this is you, you've created this many times to avoid creditors. Well, guess what? IRS will go after that. What happens if the revenue officer is working the case, or maybe you've done this prior? IRS will do their due diligence. By the way, on the IRS financial statement, it asks if you've transferred property within the last 10 years. It's on the first page of the 433A. So you better be careful. They're going to check. They use LexisNexis and other tools to go ahead and see what you own. So what happens now, the revenue officer who's working the case sends it to district counsel. District counsel looks at the facts of the case, makes a determination, and many times when you've transferred the property without consideration and you owe back taxes, boom, they jump all over this and they file a federal tax lien based on the alter ego doctrine. If you need me for any IRS problem, I worked for IRS for 10 years. I'm an expert in these matters. Thank you for listening. Please give me a subscription. They actually thrive. They're my cereal in the morning. Thank you.